The fixed deposits we often set aside in our youth can ultimately be tapped into to cover medical expenses in our later years. Does the idea of such an investment ever cross your mind? Isn't this a common concern? But what if I told you that when you invest in mutual funds, you also receive free health insurance? Would you believe me? Well, you'll have to, because I'm stating a fact. Most mutual funds offer health insurance benefits, while traditional investment options like fixed deposits do not. In today's episode, I'll explore various investment instruments with you and compare them to mutual funds. By the end of the episode, my goal is for you to have a clear understanding of which options are leading the way and which ones are falling behind. In previous episodes, we've delved into many aspects of mutual funds, such as their types, reasons to consider investing them, and key factors to ponder when investing. However, you might still have a lingering thought that says, "Oh, forget all this. FDs are the best choice for me." If this thought hasn't crossed your mind, perhaps your parents have already suggested it. But is it really the best option? Fixed deposits are undeniably secure and straightforward to manage. So, it might appear as the top choice, right? Or is it not? Can't make up your mind? Let's dive deeper into this topic. Mutual funds versus fixed deposits. A fixed deposit is an investment option provided by banks and non-banking financial companies, NBFCs, like Muthoot Finance Limited and Aditya Birla Finance Limited. FDs offer higher interest rates compared to traditional savings accounts, with interest rates regulated by the RBI, provided you don't withdraw your money before the FD matures. However, you can make an early withdrawal by paying a penalty. FDs are likely something you've frequently heard about from your family members, like whenever you have extra money, just put it into an FD. There's no denying that FDs offer security and reasonable returns. But times have evolved from our grandparents' days, and today's fast-paced world calls for something more dynamic. Sometimes, to achieve something extraordinary or surpass the ordinary, you need to step out of your comfort zone and explore new opportunities. Who knows, you might uncover a hidden treasure. It's in this exploration that you'll come across mutual funds. Let's start with the first point: options. In fixed deposits, you have one option: a lump sum investment with a fixed interest rate for a certain lock-in period. Mutual funds, on the other hand, offer diversification and potentially higher returns. Mutual funds provide the flexibility to withdraw your money at any time. If you don't have a lump sum, you can make monthly investments, SIP. But can't you do this with recurring deposits? This brings us to our second important point: returns. Returns are at the heart of any investment discussion. FDs are like your daily staple food, consistent but not necessarily exciting. Life also calls for variety like kebabs and noodles. This is where mutual funds shine, offering a buffet of investment options. If mutual funds are linked to the market, SIPs or debt mutual funds are options with lower risk and better returns than FDs. In contrast, equity or hybrid funds offer even higher returns with a bit more risk. FDs, however, offer fixed returns, and in times of inflation, higher returns are considered better investments. This brings us to our third point: inflation. Post-COVID, global inflation has been fluctuating. FDs, with their fixed interest rates, are less affected by inflation. In contrast, mutual funds can adjust for inflation, offering the potential for better returns. Now let's shift our focus to mutual funds versus stocks. First, let's clarify what stocks are. Simply put, stocks represent ownership in a company. When a company does well, its shareholders benefit. So, why might stocks be a better option? Individual stock trading is relatively easy, thanks to user-friendly apps. Stocks have the potential for substantial returns. For example, during COVID period in 2020, shares of Viva increased by 62% in just 1 year. Stocks generally have fewer charges compared to mutual funds, which come with various fees. However, before diving into stocks, consider the risks. While FDs are safe but offer lower returns, stocks offer higher returns with higher risks. Mutual funds can be seen as a middle ground. They are better than stocks because stocks can experience large losses. While Viva's shares increased, stocks like Occidental Petroleum or Coty saw significant drops. Mutual funds spread risk across multiple investors. Researching stocks is time-consuming and challenging for those without financial market knowledge. Mutual funds provide professional fund managers to guide you. Mutual funds offer both short-term and long-term options, including disciplined choices like SIP. Stocks lack this structure. So, while stocks shine with potential, they also carry more risk. FDs are safe but provide lower returns. Mutual funds offer a balanced option with professional management and flexibility.